In this example, we're going to take a series of costs associated with the acquisition of land and figure out how much of which of the costs would be for land and which ones would be for other stuff, and we'll indicate those as we go along. When land is acquired as a building site, all costs to purchase the land are prepare it for the new buildings are considered a cost of the land. Indicate whether the following costs should be recorded in the land, building, or land improvements account. Now the first cost we have is $200,000. It's the purchase price of the land and the old warehouse. You'll notice that it all goes to land, and that's because the primary purpose of this land purchase is for the land and to demolish the old building and to build a new building on it. So we're not buying it for the old warehouse, we're buying it for the land only. So we're not going to allocate any part of the money to building, just solely to the land. Next we have $5,000 of closing costs. Those $5,000 of closing costs, because the purchase of the property is solely for the purpose of the land, all of the closing costs are also going to be for land. If we had allocated some to building on the prior part, the $200,000, then part of this would also go there too. But in this case, again, we just want the land. Next thing we have is $20,000 cost to tear down the old warehouse. Again, we're still preparing the land for our new building, so we're going to add this all to the price of land. Next we have $11,000 cost to level the land. Again, we're still preparing the land for the building site, so we're going to put all $11,000 to land. Next we have $25,000 cost to excavate land for the foundation of the new building. Now we're doing something specifically for the new building, therefore these costs will go to the cost of the building. Next we have some architect fees for the new building, and similarly all of these costs will go to the building. Then we have contractor fees for building the new building, $540,000. That will all go to building. Next we have $7,000 of interest paid on the construction loan before the building is completed. Normally interest paid as interest expense and can be expensed in the income statement currently. However, when the interest is paid on a loan that's for a construction period before we can use that piece of that building, then that interest cannot be expensed currently and must become a cost of the asset, in this case building. Next we have $5,000 repair as a result of the windstorm damage during construction. That is an immediate expense, repair expense, so that's where that $5,000 goes. Next we have $12,000 cost of parking lot. All right, we're doing something to improve the land. Doesn't have anything to do specifically with the building, but with a piece of the land next to the building to provide a parking lot, and that $12,000 will go to land improvements. Also $8,000 cost of landscaping. That amount will also go to land improvements. Again, we're improving the land and it's not exactly on the building. Now normally the initial landscaping job will get added to a fixed asset account and depreciated, such as land improvements. From here on out, just the normal maintenance of the landscape, replacement of flowers here and there or trees, that's going to be an immediate expense. So in summary, $228,000 of all these costs that we've had will be the total cost of the land. The $200,000